Hi, everybody. It's Friday, the 27th of March. We're ending up March like a lion that's going out like a lamb. And I'm here with my good friend Greg Newton of NakedShortsTypeBad.com down in sunny Florida. How you doing?
Not too bad, Dave. Hi, everybody.
Greg is moving into his apartment, so you can hear a little bit of an echo there, and there's a little bit of furniture coming in. We had one hell of a month. The last year has been a year marked by lots of really great headlines. You know, the greatest bear market in history, the greatest bull market, the greatest day in history, the worst day in history. The latest one is now we've got the biggest rally since 1991 on the monthly, which goes back to the end of the first Gulf War, really. Lots of stuff like that. And the headline in the Wall Street Journal, Greg told me this morning, says that we're in a new bull market because we're up 20% off the lows. So any thoughts about all that, my friend?
Yeah, I would take all these extremes with a little grain of salt, as I'm wont to do, and Monday's little rampage on the basis of news, which was pretty well out in the marketplace, about government's plan to buy the toxic asset, or to get the so-called public-private part to get the toxic assets off the bank's books, was greeted with acclaim. Nothing's actually happened yet. Whether or not people decide to play along with this scheme has yet to be seen. So it's just been one of those. We've had so many in the last 12 months or so, and especially since, I guess, September. There's just been a little gratuitous market violence and in both directions, and we eventually managed to split up of it 150 points today, and anybody who's been on board since March the 5th or whenever it was probably wise to take a little profit, take a few profit at this point.
We came close to getting along a few things over the weekend, last weekend for Monday, and you know, folks, we use weekly charts primarily, and it's a black and white thing for me. I'm not going to go chase something on Monday if it's not indicated to me by whatever took place on Friday. And I just have to live with that. Sometimes it works to our benefit, and sometimes it doesn't. One of the things that has been working to our benefit has been the monthly DeMark readings, which certainly, at least in this particular case, telegraphed this rally pretty well, or this reversal. So that worked well, and of course we were incredibly oversold on relative strength indexes on monthly charts. So it's quite logical to expect some kind of reaction to those kinds of combinations. Any thoughts, Greg?
I just think it's obviously difficult for anybody looking at long-term chart, longer-term charts these days, simply because we are, in fact, in a trading range. And a lot's been made of the fact that oil's gone from 35 to 55, let's say, in a relatively short period. And if you were clever enough to pick the bottom, clever enough to sell at the top, which I guess was the close yesterday, you made a lot of money very quickly. But, I mean, given the head fakes, the reversals, and what have you, all the stuff that went along the way, both there and in the stock, we're in a trading range environment. For all the excitement about what's happened in equities in the last 3 weeks or so. Now, let's just remember that the NASDAQ only just got back to even on the year yesterday and is probably negative again certainly by the close today. So it's a grind them up, spit them out kind of environment.
We get a few things going, and then they just don't get going. I mean, they just kind of sit there and stare at us. Certainly, I think that if we are going to come to some kind of an economic recovery of some point down the road, and markets tend to anticipate those things. Certainly the commodity markets have to do better. That's sort of where we're positioned at the moment. And we're off to the races, and then they take it all back, and we just sit there. Certainly that's been true looking at gold, for example. It just can't get out of its own way. One of the things that's going on, of course, Greg, is what's going on in hedge funds. There was a lot of publicity about hedge funds this week having to do with how much money folks were making, and at the same time with the Treasury proposal to become a regulator of hedge funds. I don't know how they'll go about doing it, and what are your thoughts? Because Greg, of course, has been following and is an expert in hedge funds for quite some time.
The annual Alpha magazine, which is published by Institutional Investor, published an annual report of the top hedge fund earners. I, again, take those numbers with a little grain of salt, but nobody has actually sort of ever stood out and said these are absolutely ridiculous numbers. You shouldn't pay any attention to them at all. So I wouldn't look on them as paradigms of precision, but they're certainly indicative. Perhaps the most important thing about the numbers this year was that most of them were down quite substantially on the year before, and also that a lot of very well-known names who've been on that list for as long as it's been published disappeared off it. And it's likely to be some time before they come back. It's an interesting league table. If you just Google alpha hedge funds or something, you'll probably be able to find, if you missed the stories this week, it's an interesting survey. The regulatory proposal, which Tim Geithner put before one of the House committees this week, is very similar to stuff that's been talked about for quite some time now. And I think the hedge fund, certainly the hedge fund, people know it's coming in one form or another. I mean, the interesting thing is that in all this chaos over the last few months, while hedge funds have taken, along with everything else, have taken a beating, it's generally speaking been nowhere near the same sort of beating that the market itself has taken. Most funds, the hedge fund indexes lost about half what the main equity indexes did. There are concerns about the so-called shadow banking system, and it's probably entirely appropriate that they be brought under some sort of regulatory regime. The big question I have is whether or not the so-called investment advisor registration, which is something they tried a few years ago. The fact of the matter is that virtually all of the big hedge funds, the ones that are associated with the people whose names are in the alpha list, for example, virtually all those funds are registered in some form or other with the SEC anyway. I mean, they all file their quarterly returns on their reports on their stock positions. As I say, the vast majority of them are registered either with the SEC as investment advisors, and they've done that voluntary in most cases because their institutional clients insist on it, or with some of them are registered as commodity pools with the CFTC. So by itself, this registration thing is not going to achieve a great deal. The problem, of course, as we all know, is that being proved by Madoff and various other people over the last few months that the SEC is not the greatest detective agency in the world. So when the SEC first introduced the registration thing about 3 or 4 years now, there was a certain amount of whining and wailing, but you're not going to hear any of that now.
Yeah, as we've said before, they're box checkers.
I mean, yeah, one of the concerns of introducing regulation has obviously been the argument that people would move offshore. They'd take their businesses from New York or move them to somewhere where the environment was a little cleaner.
Well, what do you think about people just skedaddling and going over to someplace more friendly from a regulatory view?
I can name 2 or 3 managers I know who have done that, most of whom have been crocs of various...
Sir Stanford.
No, the one I'm thinking of is a guy who was actually worked for GLG in London, who was clouted on some insider trading business a few years ago, and he moved his business to Switzerland. So, that was a regulatory environment in which he was able to get up to the kind of tricks which bring the industry into ill repute, and that's the way he chooses to do business. But the reality is that the big institutional hedge fund firms aren't going anywhere. We've seen situations over the years where places like the US Virgin Islands tried to attract hedge funds by offering all sorts of little tax benefits and that sort of thing. And a handful of hedge fund managers went down there, and most of them, to my personal knowledge, once they found that the schools couldn't educate their kids and the realities of life in a tropical island aren't necessarily what one hopes they'd be, most of them skedaddle back home fairly quickly. So the idea that their business is going to up stakes and move to the Caymans or wherever is patently ridiculous.
Well, I think that'll wrap it up for us. We've got April coming up, and who knows what that month will hold. Greg, thanks for being with me as usual.
Thanks, Dave. Thanks for listening, everybody, and I guess we'll do this again next week.